It looked like it was going to be a pretty rough session on Wall Street as the S&P 500 was down over 1% in the morning after hearing a bit more hawkish commentary from Fed speakers, but it actually turned into an opportunity for the bulls to yet again show their resilience. Bulls did bid up the market throughout the rest of the day, and we only closed lower by 0.33%, so we were able to retain our bullish postures across most of our market indices. So we'll review all of that information. We'll also take a look at our US dollar versus gold relationship. We'll talk about energy stocks versus oil prices tonight. We'll talk about the relationship between yields and currencies, and also get a sense of what's been going on in some of the emerging markets. Then we'll get into our trade application example, where I wanted to yet again feature a bearish setup on a software stock that looks like it's falling from a resistance area. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 17th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area so that way you can make sure you're signed up for our email distribution list. That way you can be notified whenever we post these videos. At the bottom of those emails, you'll also find some cluster signals in terms of which stocks in the S&P 500 are giving you either overbought or oversold cluster signals. Also, make sure you're on our email list if you're hoping to get our Black Friday discount code next week. We'll be sending that information out via email as we typically do each year. Most of you are already on our email list, so don't worry about that if you're already there. But in case you're not already there, that's yet another advantage of being on that list for next week if you're hoping to get that discount. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us to give us a lay of the land in terms of were we more bullish or were we more bearish here today, and which types of companies were bullish and bearish. So as we get started here, naturally it's the bigger squares and rectangles that probably catch your eye, as those are the ones with the largest market caps here in the United States and therefore have the most influence on the S&P 500. And the biggest of them all is Apple. And Apple actually had a pretty solid day, up 1.3%. Remember, the market was down today, so the fact that Apple was up over 1% was rather noteworthy. You'll also notice that some of our big healthcare and pharma types of companies did pretty well today as well. A little bit of a snapback there. Remember, we're talking about how healthcare got hit on Friday last week and has been a little bit more touch and go here all of a sudden after being kind of a consistent source of outperformance for much of the fall. But today was back in the bullish camp for those medical and healthcare companies. Johnson & Johnson, of course, a great dividend aristocrat and dividend king, up about 0.81% today. Eli Lilly, stock we actually own in one of my classes for our premium members here at Market Scholars, was up 2.22%. And then we had United Healthcare up 0.74%. Remember, United Healthcare is one of the most important companies in the Dow Jones Industrial Average, because that price-weighted index is looking at a stock like United Healthcare with a price of $515 as being more influential than Apple. Yes, I know that doesn't really make sense, but that is how it's always been done on the Dow, and that's how it continues to be. So it is what it is. But United Healthcare probably helped out the Dow a little bit here today. On the flip side, in terms of kind of the bigger squares, and one other one I'll put out just because I think it's worth mentioning, Cisco Systems, another stock we own in a different class account of mine that focuses more on dividend investing, was up very nicely today. Now, it's not nearly as giant as something like Apple or Microsoft or what have you, but it still is considered one of the key technology bellwether companies out there. Its market cap is close to $200 billion. It had a very nice day, up nearly 5% here today after reporting their earnings. So congratulations to those of you who might own a little bit of Cisco Systems in your portfolio. Let's talk about some of the red squares now on the kind of larger cap side of the equation. You can see that Microsoft was down just a touch. Hard to beat up on it too much because it was only down 0.02%, but nonetheless in the red there, so it stands out. You can see see that Alphabet also was down on the day, another trillion-dollar company there. They were down about 0.5% here today. Amazon took it on the chin a little bit more. They were down 2.3%. That chart looks like it's starting to roll over yet again. And then we saw Tesla also struggling today, down just over 2%. Berkshire Hathaway down about 0.5% here today. Remember, Berkshire is actually up year to date. So one of the rare stocks that can make that claim, especially mega cap oriented in the top 10 in the United States, but kind of had a little bit of a breather here today. Also, some of the other larger cap financial brethren of Berkshire Hathaway and Warren Buffett there. We've got Jamie Dimon's company there with JP Morgan down about 0.5%, and we've also got Bank of America down about 0.5%. So it seemed like there's maybe a little bit of underlying weakness there in the financial space, a little bit of underlying strength in the healthcare space, and then kind of a mixed bag across the rest of the board. I would say it leans more bearishly today, but it wasn't one of those overwhelming bearish types of days. Also, I would point out real quick that we did have some of the software companies really struggling here today. Salesforce down 3.5%. Remember, they are part of the Dow Jones Industrial Average these days as well. And then Intuit was down about 3%. ServiceNow was down about 2.8%. So keep that in the back of your mind, because our trade application example tonight will actually be a bearish trade on a software stock. And you can see that we have some nice supporting evidence of why bearishness is part of that category at this moment in time. Also, some of those communication stocks struggled today. Of course, a lot of people have been looking at Meta recently. It was down 1.5%. Netflix down 3.5%. Even Disney was down 2.66%. In fact, Disney was the bearish trade example that we talked about in my factor-based swing trading class yesterday. So for those of you that shorted Disney yesterday, you're on your road to profit so far. Not quite there to locking in gains yet, but at least a good first day response of where you'd like to see that company go for a bearish trade in that case. That pretty much about does it. Maybe I should also touch upon the utilities real quick. Utilities are not particularly important to the overall market. I know that probably sounds bad because they want to say, hey, now wait just a second here, Brandon, we're very important. And it is true. Their businesses are important. But the truth of the matter is their stocks are not particularly important because their stocks have rather small market caps. So they don't get the press that the technology sector gets. Nonetheless, what caught my eye with the utilities today is it was a clean sweep of bearishness in the utility space, in the S&P 500 at least. Every single utility stock closed in the red today. So a lot of times it's kind of hit and miss. You've got some that are up, some that are down. But this was pretty evident that the market didn't want to have anything to do with utilities here today. Remember, utilities have really struggled on a relative basis over the last couple of months, partially due because the market has been a little bit more resilient to the upside, where it's been willing to think in more risk-on terms, where more cyclical stocks are doing better. The other thing is, of course, high interest rates are a bigger struggle for the heavily indebted and leveraged utility space than it is in other areas that have better balance sheets. So that probably plays a role here as well. So again, we don't talk about utilities a lot because they just simply don't have the oomph to actually move the market. But in this case, I think it's at least worth pointing out that all of them were down, which was pretty decided where the market wanted to take that particular group here today. All right, let's go ahead and pop on over here to the main part of the platform now. Take a look at some of our breadth numbers. And as you can see, we had 165 stocks up in the S&P 500 today, 333 down today. So that's about as close as you're going to get to a 1/3 to 2/3 split. 1/3 of the stocks up today, 2/3 of the stocks down today. So it was a decidedly bearish day. Interestingly enough, we started pretty ugly in the session today, and there was more resilience at the end of the day than I was anticipating. In fact, that would probably be a good segue as we come on over here to the charts now so I can show you what that candle looks like. If we were to look at the S&P 500, remember this is chart 4B. For those of you that are premium members, remember you get access to all 50 plus of the charts that you see David and I using with your premium subscription. So those of you that want to follow along with these presentations, it's a little bit easier if you've also got the charting package. But anyway, on this particular chart, you can see what the candle looks like. In fact, let me right-click on that S&P 500 chart and maximize that so we can see it a little bit better. When you've got an open candle like this, What it means in this case is that we actually gapped down to start the day. So this lower left-hand corner right here on this candle that I'm kind of pointing at with my mouse, that's where we gapped down to. So yesterday's close was the lower right-hand corner of this candle. So yesterday we closed there. This morning we opened down here. And why it's open, in other words, not filled in red. So again, notice that the S&P 500 was down today. It was down 0.31%. So you might be thinking, well, shouldn't that be a red candle? Well, it kind of is. It's just outlined in red. But the center of it is what we would call empty or open. And the reason for that is after gapping lower, it spent the rest of the day crawling back towards the top of the trading range. And so in the case of yesterday, we had a gap lower, but we continued to sell off throughout the rest of the session and closed even lower than where we gapped on the open. Today was different. We gapped pretty low to open, but we spent the rest of the day going higher. So we still didn't get back to yesterday's close, but it gives you the impression that there was some bullish resilience underneath the surface. And, again, credit where credit is due. I keep on thinking this market has a lot of work to do and has some difficult moments in front of it in the coming year or so. But, it continually surprises me here over the last month. And so, again, sometimes we can get carried away with our thoughts of what we think the market should be doing when what is actually happening in reality is taking place right before our eyes. And today could have had the opportunity for a massive sell-off. We were down more than 1% when I was in my question and answer session class this morning. In fact, I told the class if we're still down by more than 1% at market close, I'll probably be doing a sold put trade for the market outlook video. And those of you that got the trade alert on Telegram know that that's not what I did, because the market was no longer down 1% by the end of the day. So I had to shake things up with my expectations as well, as the market did rebound throughout the rest of the day. And we did hear from some Fed governors today. I was in class for 3.5 hours, so I didn't get the opportunity to actually hear from many of them. But my understanding of reading the headlines was that they were talking pretty tough initially here today, like has often been the case with a lot of the Fed speakers. But after an initial sell-off in the stock market, buyers kind of emerged once again and started saying, "Hey, I'll take that merchandise at that price if you're willing to sell it off to me at that level." So, it seems like the buyers have come back and have been a little bit more emboldened than they have been in other rally attempts earlier this year. So who knows? Maybe they've got it in them to push this thing higher. I did just see a tweet earlier here before I started recording this as well from the guy who runs the Stock Trader Almanac. As I was mentioning to my students earlier today, I use that Stock Trader's Almanac as a desk calendar, so that way I can jot down notes to myself and stuff with my trade setups. But anyway, he's got a Twitter handle as well, so he puts out there some pretty interesting market statistics, and he was saying that from a seasonality perspective, during this time of year, tomorrow, so the Friday before the Thanksgiving holiday, tends to be one of the lower points during that November-December time period from a historical perspective. So his thoughts were we might find a little bit of selling tomorrow, and we could very well start rallying into Thanksgiving next week and then beyond, if the normal seasonality patterns hold true. Now, of course, most of you are aware it's never quite that easy. If it were, we would all just do whatever has happened historically on whatever given day. But each year does bring, of course, new news, new information, new geopolitical concerns, new Fed speak, and yada, yada, yada. So that's why we can't just bet the farm on what has happened on any particular day, week, or month throughout history. But otherwise, it is at least good to kind of set your expectations if you have no other way of evaluating what your assumptions are in the market at any given moment in time. It's at least a starting point, right? So that's kind of worth noting there as well. And of course, we've been talking about the bullish seasonality in November, December, January here recently in my presentations as well. So that should not come as a surprise to you guys to learn that. So maybe, just maybe, the bulls have what it takes to turn this market around. I remain cautious. I remain hesitant. But then again, part of that's my personality. As I was mentioning to my class earlier today, I think it's a little bit of a coping mechanism mechanism, quite frankly. It's a way of preparing myself for eventual difficulties in the market, and therefore if those difficulties do emerge, I'm not surprised and caught off guard and feeling really emotional about the situation. Then again, if I'm completely wrong of having those hesitancies and the market just erupts higher, I'll be tickled pink by that because all my dividend stocks and retirement money and all that kind of stuff will be doing really well. So you do have to be cautious around hearing me say something like that, because you'll probably never hear me say, okay, it's all systems go, everything is lining up perfectly, there's no bad news in the world right now, all the charts are perfect, and we just need to load up the boat, right? You're not going to hear me say that. It's just not in my personality. So, when you hear me say I'm cautious, I'm hesitant, that's kind of, par for the course for me. So, you have to understand who your messenger is, I suppose, there as well. But I guess the point that I'm trying to make is the bulls have been more resilient than what I think the market deserves to have right now. A lot of stocks are up there near highs. We talked about, IBM when I was with you on Tuesday as just one random example of a company that's been kind of out of favor on a relative basis in recent years, but all of a sudden finds itself on the 52-week highs list, right? There's a number of those types of companies out there, blue chip types of companies that are literally at new highs right now, new 52-week highs, while a lot of the market participants still have this bearish mindset out there, right? So going to have to come to terms with those two things. Is the market really bearish, or are these stocks that are hitting new 52-week highs correct, right? And of course, the future will let us all know what will win out. But considering the fact that the Fed still strikes me as being more hawkish in its tone, I would say that the market needs to prove it. It's not the other way around. Right now, the Fed is trying to guide the market, saying, we're not done yet. Our job is not done. We will continue to raise interest rates. In fact, the yield curve continues to get even more inverted. We were looking at that in my Q&A class today with the 3-month Treasury bill way higher than the 10-year Treasury note, which is, of course, very peculiar throughout history. So I think where the Fed can control things on the short end of the curve, they are still keeping rates much higher than what the market is kind of assuming is happening right now. It's like the market is trying to call the Fed's bluff, and so far neither side has really backed away. We'll continue to watch the charts and see if charts break in one direction or another, or whether they stay range bound. Right now, we're kind of range bound. Yes, we have had a very nice rally of higher highs and higher lows since putting in this low with this awesome bullish engulfing candle back here on October 13th, but we're still well within the range of the last 3 months, right? We haven't broken even to 3-month highs yet. So we don't want to get too ambitious with our bullishness, but we don't also want to get too ambitious with our bearishness, because there is proof on the chart that things have stabilized quite nicely and we are in that more bullish time of the year. Yesterday, David probably would have mentioned in his classes, actually, I think his computer has been giving him, it's been on the fritz, so he's had to take it into the shop. So I don't know exactly what he's been working with you guys on. I think he might not have done the video last night, but I think he still taught his class yesterday on his laptop. But at any regard, I'm sure if he did do the video last night, he would have told you about the bullish intermediate confirmation signal that existed yesterday. And so that's something that's kind of more in the bullish camp there as well, where we had the green line in the upper reversal zone and that red line firmly in the lower reversal zone. And remember, we had that the prior week as well on this little area right here, and we had a nice follow-up rally the next day. Today we didn't have a full-on rally, but we did have that rally off the lows, telling us again that the bulls just simply are not rolling over at this moment in time. They're not, getting the bears to just have one-sided conversations anymore. The bulls are actually fighting back here. So I think that's all in all a pretty good sign as we speak. So we remain above a rising moving average on all 4 of our charts, just like was the case on Tuesday when I was last with you, with those moving averages colored green to represent that situation. And then the background colors of the charts are all dark green still, despite today's sell-off across the board, right? All 4 of these indices were down today. Yet despite the selling of all 4 of these indices, we remain with a strongly bullish intermediate posture as well. Right? If you look at the green lines on all 4 of these charts, the green lines are still in the upper reversal zones on all 4 of them. And that's somewhat impressive. Again, it's showing you signs of resiliency within the market. Now, you will notice that the green lines have started to kind of bend lower, but because they're still above 80, we give them the benefit of the doubt up there in that upper reversal zone. But if there's a few more days, like the last two, that will eventually give up the ghost, and they will start falling out of that upper reversal zone. So let's be on the lookout for that. And when we're looking at these charts, I would say the same thing that I mentioned to you guys on Tuesday and have mentioned to you guys for several weeks at this point, which is, to my eye, it still looks like the Dow Jones Industrial Average remains the leader, and it looks to my eye that the NASDAQ Composite is the laggard. And so if you're looking for bullish trades, then looking for them in some of those mega cap blue chip types of areas might make sense. If you're looking for bearish trades, then there still could be some interesting ones in the NASDAQ, and that will play a role in the bearish trade that I point out to you guys later tonight in the video, and also played a role in that trade that I did for you guys on Tuesday. Remember, I did a bearish trade on Airbnb on Tuesday, and this thing has played out very nicely so far. Whether it continues to, anybody's guess. But when I placed that trade on that candle right there, we've had two really ugly trading sessions on Airbnb. So as a guy who did a bearish trade on it, I am thankful for that, right? It's not that I want to see Airbnb's business destroyed or anything like that, but of course I want to win my trade. And so far so good on that one. And that plays into that same theme that the NASDAQ appears to still be kind of the laggard of the markets right now. So despite it having the strongly bullish posture, it's not nearly as strong as what we're witnessing on some of these other areas. So if you're trying to kind of kick them while they're down, so to speak, then that's the area that still seems to have those types of charts that are struggling at the moment. Whereas some of the mega cap areas like your IBMs of the world and those types of companies in the Dow Jones, they're doing a little bit better at the moment. So to put a bow on it, all of these charts still have the strongly bullish intermediate posture according to the market forecast technical indicator. And the Dow was down by 0.02% today, NASDAQ was down by 0.22% today, and the Russell was down by 0.76% today. So all four of our indices down, none of them down more than 1%. So it was actually a kind of almost an intraday win for the bulls because they got all of these charts off of their worst levels of the day, and none of them closed lower by 1%. Let me go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. What we ask out of you is quite simple. We ask you to trade 5 seconds of your time for the 3 hours of our time that goes into producing these videos. And as long as we're up and over 100 likes, I'm happy to do the video at a full length the next time around, including a trade application example. So hopefully most of you are on Twitter. I know not all of you are, right? We have somewhere between, let's call it 600 and 1,000 people that will watch the video on any given day. Of those 600 to 1,000 people, we know for sure that at least 300 of them are on Twitter, which then reminds us that less than a third of the people who are eligible to click like on Twitter will actually do that, right? So that means that more than 2/3 of you who could click like for us on Twitter will not do that. And so our urging of you to do that doesn't seem to be working as good as we would like. But we will continue to work on that. And those of you who have made that commitment to take the 5 seconds out of your day to help us along with that, we really do appreciate you. And once again, there were 107 of you that stepped up to the plate that allowed me to do a full-length video for you here tonight. If we were below 100, then I would have only done a 15-minute quick hitter video on only the indices themselves. And so let's do some shout outs here. And thank you to Robbie, thank you to Jayesh, thank you to Claire and Pam and Paul and Fun Jonesy and Richie and Eugene and David and Sherry and Trunk and Rich and Sheila and Jeff and Stock Market Junkie and Keola and Janet and Ram and Curdy and Sarah and David and Britt and Rick and Greg and Ray, Rock Vid and Barry and Nikolai and Walter, Lawrence, Violina, Victoria, Teresa, Frank, and others. I can't get to all of you, but just want to acknowledge you and let you have your moment in the stars, so to speak, there. So thank you very much to all of you and everybody else who clicked like for me there. I'll do the same thing with you for the next time I'm scheduled to do the video. If you're willing to click like for me, and at least 100 of you are willing to take the 5 seconds out of your day to do that, I'll plan on giving you another 3 hours of my time when I'm scheduled to do it on Tuesday. So please keep that up. Both David and I really appreciate that. All right, let's come on over here and also remind you of what we've been working on here in our premium classes earlier today. David taught his portfolio management with ETFs class, and I taught my question and answer session. I always like to point out that the question and answer sessions that David and I both do are only for our 3-year premium members, and that is the subscription package that we'll be putting on sale next week for our Black Friday sale. So if you've watched these free videos over time and thought, boy, that would be kind of fun to be able to pick Brandon's brain or David's brain and work directly with us, then we provide that opportunity for our students each week. So today we had some great questions, as we always do, and had a question about talking about some of the long options positions we've taken, including right here in this market outlook presentation with stocks like Starbucks and Discover Financial throughout history. And then we also got a question on looking at Gorman Rupp's business model as a long-term dividend growth investing candidate. I got a question about some of the rules that we use in my top-down trend trading class and how to interpret those and think about those. I got a question about floating rate bonds. I got a question about looking at McDonald's as a swing trade. I got a question about shorting Disney. I got a question about Franklin Resources as a dividend growth investing stock. So for those of you that are premium members, if any of that content sounds interesting to you, feel free to check out the recording that is now available on our Trading Rooms tab. Also, let's have a little chat here about our factor selector tool. And a reminder for tomorrow, David will be teaching his technical analysis class. So make sure if you've got some time set aside tomorrow, check out his class as well. Lots of great stuff here for our premium members. All right, factor selector. So this was put together on Tuesday evening, so it's a little bit stale at this point, but can still give us a general sense of things. Remember, we usually go through this data on Wednesday mornings in my factor-based swing trading class. And so some of you may have been in attendance of that already, but for those of you that watch this free video, it's just another day delayed to look at some of this information and kind of interpret it a little bit. And this is a rare week where every single one of these rankings on the factors changed from the prior week. That rarely happens. Maybe once every few months you will see that. But it basically tells you that there was a big jolt to the system. It's kind of like those pads that you put to try to resuscitate somebody on their chest if they've had a heart attack or something like that, right? It feels like this market had a jolt last week. And as I was explaining to my students, to me, the jolt was not what happened on Thursday when we had that epic up day where the market was up the most that it had been in over 2 years, because that day we had like 96% of the stocks that were up. That was not the jolt that would cause a massive reorganization of the rankings here. The real jolt happened on Friday. The market was only up 1% that day, but what was happening underneath the surface of the market was incredibly peculiar, where there was a lot of money that was being extracted from the once hot areas, and it was rotating into some of the areas that had been left behind. And of course, that then has an impact on the rankings of these different factors that we are evaluating from an ETF performance perspective as well. So lots and lots of shakeup here this week. You can see we've got new bookends. On the top, we've got value that has taken the crown, so to speak, and you can see here as you kind of walk it back in that orange coloring that this is the first time in at least 3 months that value has been number one. And low volatility is on the other bookend, with being at the bottom. Now, low volatility was at the bottom here one other time in the last 3 months, back at the end of October. So maybe not as big of a surprise on that one. Remember, low volatility is where you're going to find a lot of those utilities that I had mentioned earlier with their interest rate sensitivity. So that particular area has not been able to keep up with some of those more cyclical areas out there. So lots of shakeup there. Momentum fell off the cliff over the last week as a result of that massive money rotation that took place on Monday. Now, this can change back, so keep in mind, 1 week does not make a trend, but it is at least worth noting. And of course, if we're paying attention to this on a week-by-week basis, we should not then be surprised and just randomly wake up 3 months from now saying, boy, I had no idea that was happening, right? That's the benefit of evaluating, interpreting the data each and every week. So anyway, there was a huge jolt to the market, and from my perspective, the biggest chunk of that jolt took place on Friday of last week, and now that is part of the rankings when I reordered the rankings here this week, which would have included Friday's data. Remember, the prior week we would not have had Friday's data yet because it gets done on Tuesday night. So anyway, be aware there's a lot of shakeup going on here in the markets right now. And I spent a lot of time, by the way, in my Monday top-down trend trading class talking about that rotation underneath the hood of the market. So for those of you that are premium members, feel free to refer to that recording from this past Monday if you want to hear my thoughts on that topic a little bit more. All right, let's go ahead and get back on over here to the Thinkorswim platform. And let's go ahead and take a peek here at, let's see, where are we at? Let's go do some 12 grid analysis. So let's take a look here at chart 5A. And a reminder, as this gets pulled up here, the pink background charts are the ones that have bearish intermediate postures on the market forecast, and the green ones are the ones that have bullish postures. So as has been the case for much of this year, let's start in the lower corners because those are the two areas that have really dictated what's going to happen with stocks. Starting with the US dollar in the lower right-hand corner here. I'm sorry, lower left-hand corner. The other right, Brandon. Sometimes I catch myself saying that and I wonder how many times have I said that and not caught it, because I'm sure that happens plenty. But when you have to talk as much as I do, naturally you're going to say some things that you don't mean to say, but just somehow come out of your mouth wrong. So anyway, lower left-hand corner, so that way we're all on the same page here. This is the US dollar, and it has been the case for the last 3 weeks. The US dollar is in the process of breaking down, and that has been a beautiful thing for stocks. It is not a coincidence the stock market has caught some wind in its sails, both U.S. markets and foreign stock markets, at the exact same time that the U.S. dollar is breaking down. All else being equal, it's easier for stocks to go up when the U.S. dollar is weak. The U.S. dollar is oftentimes viewed as a safe haven. Money oftentimes floods out of riskier assets like stocks into the safe haven asset of the US dollar, which some people will refer to as the cleanest, dirty shirt in the laundry, or some people would say the best house in a bad neighborhood, right? So in other words, very few currencies around the world are truly robust because all of them are incentivized to inflate their currencies. But the US dollar is the one that is oftentimes viewed as kind of the go-to currency because it's the reserve currency of the world, and right now it has a central bank that is basically suggesting that it wants that yield to stay high and therefore the currency to also stay high, all else being equal. Remember, there are always international investors hunting down government bonds across the globe, trying to find out where their best risk-reward balance is. And so when interest rates remain high in the United States, oftentimes the US dollar gets a benefit from that, as some investors around the world will sell their securities in their home currency and have to buy the US dollar in order to then invest in the U.S. Treasuries to get those higher than average yields. So it all kind of works together in that regard on occasion. So right now, when the interest rate has actually been falling, it's happening once again at the same time that the US dollar is falling. And of course, before that, it was the opposite. When the interest rate was rising, the US dollar was rising. And that's not what the stock market wants to see. So if you're somebody that wants to see stock prices continue to go higher, which of course many of us probably do desire that, maybe not for your trading accounts or what have you, but for long-term retirement assets, most of us prefer the stock market to go up. So another way of saying that is we want the US dollar to go down, and we want the Treasury yield to go down as well. And fortunately, that has been exactly what has taken place in the last few weeks. So where we stand right now with the US dollar was actually up today, not by much, but it was up 0.38% today. But you have to remember context here. This thing had been down like 6 out of the prior 8 days or something like that, and had been not just a gentle decline, it had been a wipeout decline for a currency like the US dollar, to the point where you actually were selling off so hard it resulted in oversold cluster signals. And we probably haven't had a lot of those in the dollar here recently because it's been relatively strong this year. So this is one where maybe we're due for a little bit of a reversion to the mean type of a rally. But unlike when I expected a reversion to the mean rally over here, my expectations now is if we get this reversion to the mean rally in the dollar, that it's probably going to have a hard time clicking back into its prior uptrend. Anything is possible, naturally, but in this case, you got to try to play the odds. And what is your mind telling you? What are your eyes seeing? What I see is a broken chart. And so, can we get back up here? Sure. It'd be nice to see us kind of test this little area from the bottom of the candle on October 26th and the bottom of the candle there on November 8th. I think that's about as good as we could get in this current stretch. Now, again, that is somewhat dictated on what happens with the Federal Reserve policy and what they suggest through their interest rate decisions and things like that. So, when we're dealing with macro events, things can move around much more wildly than what you might find in other asset classes. So you do have to, be cognizant of that. But from just a purely technical charting perspective, that's kind of where I'm thinking in my head right now, is about as far as the US dollar would be able to get to before the sellers would emerge again. And remember, that's a good thing for the stock market. So that's where another, you've got another feather in the cap for the bulls out there. This thing has been blitzed so hard that it's a broken chart now. It's not just a downtrend, it's like a broken chart. And therefore, any effort it's got back to the upside is unlikely to carry it all the way back up here to say, hey, we're back in an uptrend again. So I think that's a positive sign for the market, all else being equal. It does continue to have a strongly bearish posture, and it does have price below a falling 30-day moving average. That is now also the case on the 10-year U.S. Treasury. Notice here that on Tuesday when I was with you, I was saying how the 10-year Treasury yield chart did not look as ugly as what I thought the U.S. dollar chart looked like, but it could have the possibility of following it in that direction. And one of the reasons I was making that comment was not because it wasn't breaking support. In fact, I was specifically showing you that it broke that support right there with this candle. But why I had made that comment on Tuesday is because the moving average was not yet red. Now look at where we're at 2 days later. It is now red. So on Tuesday, we were below a rising 30-day moving average. Today, we are now below a falling 30-day moving average, which is why we have that color change taking place on the chart there. Now, this one would have an easier job to click back into its uptrend compared to the US dollar, but still, the more that this kind of wears and tears to the downside, the greater the chance is that whatever reversion to the mean type of a move it's got ahead of it, it could be using that 30-day moving average in the future as resistance to bounce down and away from. So we want to keep our eye on that story. So both of these charts, I think, are supportive of the bullish market environment that stocks find themselves in right now. So price below falling 30-day moving average, strongly bearish posture on the 10-year Treasury yield as well. It was actually up today, so it's worth pointing out that the Treasury yield, the 10-year, did close at 3.77 today, which was off of yesterday's closing low here. That was quite a bit lower. So, they had a little bit of a move today, but it wasn't enough to change the posture, and it wasn't enough to change the color on the moving average. One chart that's been kind of interesting to me here recently has been oil. We've talked a little bit more about gold because gold is kind of stealing the thunder right now. Some of you saw my tweet yesterday of the nice young couple, and the young lady is pregnant, showing that she's probably going to be due any time now, and there's going to be new growth in the family. And then you've got this awesome dog. I don't know what kind of a dog it is, if it's a Weimaraner or what, but it's just a classic picture of this dog that is photobombing this really great picture of this couple. And so I was joking that the dogs of the Dow technique is stealing the thunder from the growth techniques out there. So sometimes we get enamored with the really exciting thing that is taking place at any moment in time. And admittedly, I haven't been sharing my thoughts in this presentation as much about oil here lately because I've been kind of enamored with what's going on with gold. Gold has just been a rocket ship to the upside. As the dollar has plunged, gold has gone the absolute opposite direction, which is the typical relationship between those two assets. But you will notice that gold was down today on a day when the dollar was up. So is it possible we start getting this reversion to the mean move on the dollar up? And if that's the case, then does that also mean that gold will have to give back part of this move right here? But I'll say the same thing, just 180 degrees different of what I just mentioned on the dollar. Gold is so far up above its rising moving average that any sell-off it has in front of us has a greater chance to be bought than for this to click back into its downtrend. It's the exact opposite of the dollar, right? Those two things play together because of their inverse relationship. So right now my assumption is, yes, we could get a reversion of the dollar back up and a reversion of gold back down, but neither one of them have a very good chance of clicking back into their prior trend because this move has been so jarring to the upside on gold and so jarring to the downside on the US dollar. So I haven't been talking as much about oil, but it is interesting that oil has started to break down here a little bit as well. Oil has been one of the better asset classes year to date, but on a 3-month basis, it's now down 2.65%. And you can see it's now trading below its 30-day moving average, which is now lower as well, right? So yesterday it had a yellow moving average. Today we're now back to red. And that's the first time we've been in red, with the exception of that one random day right there. But otherwise, it's been back here since we've been consistently red. So it's going to be interesting to see where oil will go from here as well. And remember, oil has slightly different dynamics than what you're finding out of gold and some of the other commodities these days. Oil is kind of being pushed around by whatever headlines are coming out of some of the more politically hot areas of the world right now, geopolitically hot, like Russia and Ukraine and other oil-producing areas of the world, and whether they're going to have more supply than demand, and what that means when we start thinking about a possible recession in front of us, and yada yada yada. So there's a lot more that kind of goes into the thinking of the pricing of oil there, but it is starting to break down a little bit. It's more of what I would say is a sideways chart right now, so I don't want to make too much out of it, but I at least want to point it out and identify it for you, just in case, 3 weeks from now we're talking about this major meltdown in oil prices or something like that. I don't want you to come back and say, boy, how did we miss that the whole time, right? Because again, I've been kind of enamored with gold so much, we haven't been talking about oil, pulling back, not nearly as aggressively as gold is going up, but nonetheless, still a pretty decent move from its high that it just put in here on November 7th. So keep your eye on that. It seems like maybe there are some winds of change there in the oil world as well. And that kind of plays into what I had mentioned earlier about that massive disruption that took place on Friday, where most of the once hot stocks in the market sold off and gave way to some of the areas that had not been as hot. And I suppose you could kind of take that theory and apply it to oil as well, because remember, oil had been one of those areas that had been hot. The energy stocks have been kind of the only market leaders of this year-to-date basis for the most part. And so if we do start seeing continued selling of the once hot leaders, that would include the energy stocks, and that can play a role in the sentiment and psychology of oil itself. Speaking of sentiment and where things are pretty ugly these days, let's talk about cryptocurrencies. Off on the right-hand side here, you can see Bitcoin's trying to get up and off the mat here today, but does remain below 17,000 as we speak. So it's still got work to do, but at least it has seemingly stopped going down. And, you got to start somewhere, I suppose, because this was a pretty awful drop in Bitcoin prices here. And, of course, most of that was happening at a time when this whole Sam Bankman-Fried thing emerged, and all of the scandal and the fraud that seems to be taking place over at FTX right now. Obviously, I'm just saying that out of speculation because I really have no business commenting on that, as I really know next to nothing about it. Nonetheless, I'm just picking up what everybody else is saying on Twitter and on CNBC and elsewhere, that it surely looks like a fraud at this moment in time. But I'm sure Sam will have his day in court, and maybe he can defend himself and say why it was an honest mistake. But I highly doubt it, given what we have seen come out since then. So that has left a little bit of a scar on Bitcoin. Now, remember, it really shouldn't. Bitcoin is completely separate from FTX, but all of those things are kind of lumped together because, there's a certain subset of investors and traders out there that are still not willing to even consider cryptocurrencies at all. And so they kind of think of them as all the same thing in their head, when there are actually distinct differences between them. So we shall see. What I would say about the Bitcoin army out there is that it seems like they are the ones with the most resilience, right? They are the ones that are committed to the asset class come heck or high water, right? They are the ones that are the hodlers, the ones that will hold on for dear life no matter what the price is. They're basically buying their Bitcoin and taking it off the open market and never having any plans to sell it, or at least that's kind of the vibe I get from a lot of the evangelists of Bitcoin out there. So, if there is a if there is a cryptocurrency that has a decent chance to survive whatever sort of a crisis moment the crypto world is going through right now, you'd have to think that Bitcoin is amongst the survivors, if there will be any survivors. So I think it is still an asset class that's worth at least looking at on occasion, and there will be trading opportunities that emerge from it once the smoke clears. But right now, you can see that the trend is still decidedly bearish. This still has a strongly bearish posture. It obviously is trading well below its falling 30-day moving average. Now, similar to the US dollar, there's always the chance that Bitcoin can have a reversion to the mean type of a rally, but I would venture to guess that if we get back up here towards the underside of that moving average, that there will be some sellers that are willing to step in, and that cryptocurrency may very well struggle at those levels. So we'll keep our eye on that. If something changes there, we'll let you know, because we know it's a hot issue. Everybody's talking about it right now. All right, let's see what else is going on out there from an asset class perspective. All of our bond charts do remain above their moving averages. TLT is not quite above its rising moving average. It's still above its falling moving average. But those of you that are premium members, you'd have seen my Telegram note that I sent out to you. I believe it was yesterday morning, that I did roll our previous trade that we had going on TLT. So be aware of that. We're now out to January on that one. So that's another benefit our premium members get. Not only do they find out when we place the trades for these market outlook videos and for our premium trading rooms, but they also learn how we manage those trades and when we decide to exit out of them and get out of them. In fact, that was another thing that happened earlier just today, is I did shut down that Micron bear call spread that I had done. Now, I only got 2 cents worth of profit out of it, but it's better than not having a profit. And like I said in Telegram when I sent it out to you guys, what I was hoping to avoid was for Micron to have some sort of a random bounce between this morning and tomorrow afternoon when those contracts expire, and then put us back in the money. And wouldn't you know, that's the exact thing that played out this afternoon. Now, of course, I don't know what's going to happen in tomorrow's trading, but what I do know is that I shut down that trade at a profit this morning, and for the rest of the day, Micron did climb and is now back in the money. So I would have regretted had I not acted when I did here this morning. So again, that's another big benefit that our premium members get. It's not just hearing what trades we're putting on, it's learning when we're taking them off and how we're managing those trades. Anyway, TLT does have a strongly bullish posture, but its moving average at this moment is still going down, whereas foreign bonds and high yield bonds are trading above their rising 30-day moving averages and have also their strongly bullish postures. Up above here, where we've got our different stock markets around the world, emerging markets did pretty well today. They were actually up 0.18%. Stocks like Alibaba have been really interesting to watch. I heard them say on CNBC today that Alibaba is up 45% from its lows over the last month. Remember, Alibaba is not some sort of a overnight, type of a company. It has been a company that has been successful for a decade, and of course has done its IPO along the way, but it's existed well before that. But it is a huge, huge, important company worth hundreds of billions of dollars. And so to have a company like that go up 45% in a month is going to have an impact even on EEM here, which tracks the broader emerging markets. It's not even specifically China. This is China plus a lot of other countries, but Alibaba by itself does have an important role on the sentiment of this entire category. And so EEM actually managed to close barely in the green today and remains with that strongly bullish posture there. EFA, which tracks the developed foreign stocks, did not close higher today. It was down just fractionally, but does still retain its strongly bullish posture and above its rising moving average there as well. Let's go ahead and take a look at our sector 12 grid now, and this is chart 5C. And as we look at this, I see a handful of them that were up today, just actually two. It looks like technology was up today by 0.13%, and energy was up today by 0.22%. So far, we really haven't seen the energy stocks get decimated, despite the fact that oil is trading below its moving average right now. So it's going to be interesting to see which one of them is right, all right? Because obviously they're not going to stay separated forever. Either one of two things is going to happen. Either energy stocks are going to go down to meet oil where it's at right now, or oil will, eventually just say that was a head fake and go back up to find out where energy stocks are. So there's a little bit of a conflict between the underlying commodity and the producers of that commodity right now. So it'll be interesting to see how that shakes out. But from a stock chart perspective, XLE still looks reasonably good, right? Especially compared to everything else that is out there right now. So they did manage to close well off their lows and actually close basically at their highs of the session, which did manage to make them into positive territory here today. And so that's still probably the strongest chart on the board from a trend perspective. Technology also closed higher today, probably because of Apple. Remember, XLK, what we're using here for the technology group, is market cap weighted as well. So Apple will also have a bigger influence on XLK, just like it will on the S&P 500 itself. So my guess is that Apple really helped XLK today, because remember, the software stocks were down quite a bit here today. So Apple pulled more than its fair share of weight here today. Discretionary is actually the only chart that is now pink. And remember, that is the area that I extracted our bearish trade idea from on Tuesday. So far, so good. As I mentioned, Airbnb has been down significantly the last 2 days, and it's kind of fallen in line here with what has happened with discretionary in general. Of course, discretionary got a little bit of a black eye yesterday with Target, and then tonight after hours, Williams-Sonoma is also struggling after hours. So there's still some kind of touch and go moments with consumers right now where we're trying to figure all of that out, and I think that's having a negative impact on discretionary right now, whereas we're not necessarily seeing that across a lot of the other sectors. But if you've got some bearish trades in the discretionary category, like my Airbnb, or maybe you're doing, we did a bearish trade on Tesla here somewhat recently in my factor-based swing trading class. I've also had Amazon kind of on my short list of possible bearish trades. So there's a number of them out there where the charts just don't look all that healthy yet. So, that's a place where maybe you can go hunting for some ideas if you're looking for some bearish setups. In terms of which sector was the worst one here today, it does look like it was utilities, down 1.75%. And having said that, it does not surprise me. I didn't know that until I was looking at it right now here with you. But given what we saw when we were reviewing the S&P 500 heat map earlier in the presentation, that should not come as a surprise. Remember, that was the sector that I had shown you. Every single component of the utility sector was down in the S&P 500 today. So while they weren't down significantly in most cases, it was the consistency of all of them being down that led to this end result of them being the worst sector in the market here today. All right, let's get into our trade application example now. And I'll just come on over here and pull up chart 3A, our swing trading chart for this. And I'm going to pull up, speaking of dogs, I guess I didn't even think, to include that in my comedy earlier in the session. I know some of you were just falling out of your chairs with what I was telling you about the dog doing the photobomb in front of the pregnant couple. You have to see it. I know I'm not really setting that up all that well. So go to my timeline on Twitter. You got to see that photo. It's awesome. Especially if you're a dog lover like I am, you'll just see the joy in that dog's face as he is photobombing that couple. But anyway, speaking of dogs, this is Datadog, ticker symbol DDOG. For those of you that aren't aware, kind of another fun ticker symbol in that regard is just simply DOG, dog. This is the inverse Dow Jones ETF. So for those of you that think that the Dow Jones is due for a sell-off, then this is a ticker symbol that you could buy to take advantage of that. But what I'm talking about today is DDOG, Datadog. And this is one of those software companies that's been so popular here recently. It kind of reminds me of the setup that we had with Airbnb on Tuesday, where it was up there at that falling moving average and had a decent chance of rejecting it, which is exactly what we've seen in the 2 days following it. It also somewhat reminds me of my CrowdStrike trade that I did back here. Now, for those of you that aren't aware, speaking again of the benefit of receiving our Telegram notifications, not only when we put the trades on, but also when we're getting out of them, I'm already out of the CrowdStrike trade. In fact, we tripled our money in 3 days on that particular trade, which is not something that happens all that often. It's like once in a blue moon type of a thing. So we're already out of that. In fact, I was looking at this one again today and I was licking my chops. I'm like, man, I really want to take this bearish trade again on CrowdStrike, right? Let's roll the dice again and see if we can come up lucky sevens 2 times in a row. But then I saw we had that earnings announcement coming up here, looks like in just the next couple of weeks. So it's a little bit more dangerous taking trades through an earnings announcement because you always have the possibility of a gap against your trade to kind of spoil the party. But if you're not afraid of that earnings announcement right there, it looks like CrowdStrike is setting up for another really interesting bearish trade. One thing in that regard that I would point out about CrowdStrike and the trade that I did select tonight that might be a fly in the ointment. Notice after hours CrowdStrike is trading at 145 even though it closed at 139 today. And the reason for that, at least my guess, is Palo Alto Networks, PANW, came out with earnings here today. And it looks like they easily beat analyst expectations. In fact, it looks like they smashed analyst expectations. And you can see that the stock is trading up at 167 in the after-hour session, even though it closed at 156. So tomorrow will likely be a day where a lot of the software names trade up in sympathy, at least in the morning, with what we're seeing out of Palo Alto right now. So just be aware of that as we talk about this setup here as well. DDOG is the ticker symbol for Datadog. So let's talk through the chart here a little bit and what might be impressive about it for a bearish type of a trade. So first of all, notice all of these labels up at the top of the chart are red, telling us that we have negative performance in all of these time periods, everything from 1 month to year to date to 3 months, 6 months, 9 months, 1 year. It doesn't matter. This is a chart that is underperforming in all of those time periods. It just cannot get out of its own way. You can see it's obviously underperforming the S&P 500 itself with that dotted gold line up above it. You can see that today was the fresh day where our background color went from blue to pink, telling us that the near-term posture has gone from bullish to bearish with today's sell-off. It was down 4% today, by the way, so a pretty big sell-off there for this company today to push us back down and below that moving average. And again, that's kind of why I think the CrowdStrike one was a little bit more interesting, because here you didn't actually have a big break of that moving average. Datadog, you did. So it does kind of throw a little bit of a fly in the ointment there, making you wonder, hey, this was a pretty big push from the bulls. Maybe this one won't go as bearishly as some of the others. But at least after 1 day here, you can see that the bears are alive and well, down 4%. But again, this one is up about somewhere between 50 cents and $1 after hours in sympathy with Palo Alto. So this one has the possibility of popping back above that moving average as soon as tomorrow, especially if technology is hot. So we'll keep our eye on that. But given what I knew at the time when I placed the trade, which of course was during the normal market session today before Palo Alto reported, this one looked like it was setting up more bearishly, falling below that falling 30-day moving average, fresh posture, and then you've got a little bit of a bearish near-term divergence signal here as well. where you've got a peak in that blue line right there, followed by a lower peak down below. And the two candles associated with those two moments are this candle right here and this candle right here. And while this was a sell-off day candle, its close was slightly higher than the close of this candle. So it's not maybe a textbook example of a bearish near-term divergence, but if you look hard enough and you squint at what the actual closing prices was, technically it did exist in that regard. So what I chose to do in today's case was a long put spread where I bought one in the money and I sold another one out of the money, with the hope that this stock falls pretty hard. Remember, when I buy a put spread, it's a bearish trade, but I do need it to be directional. In other words, I can't just have it go sideways. I need this thing to fall if I'm going to make good profits off of it. The other possibility would have been to do what's known as selling a bear call spread. There, an acceptable outcome is for the stock to go sideways. So this one is a little bit more directional by nature, but it's not quite as directional as my CrowdStrike example that I showed you a couple of weeks ago, because that was just a flat out buy a put without selling any other put against it. This is similar in that I'm also buying a put, but I'm selling a put against it to kind of offset the costs of that trade. So in an ideal world for me, the way that I set the trade up, I want this Datadog chart to come down here to $70 or less. Okay, so that's what I had for you here this evening. Hope you enjoyed that presentation. As I mentioned earlier, all we ask out of you is to take an effort of 5 seconds out of your day and click like for us there on Twitter. You can either do it directly on Twitter, where it's pinned to the top of my timeline, or if you're watching this video on YouTube, you can look in the description area underneath the video to find the tweet in question. You can also find the tweet in question on that icon at the bottom of the emails we send you guys. And for those of you that watch this video directly on the Market Scholars website, there's a Twitter widget directly below the video where you can go to it as well. So there's 4 different easy ways for you guys to help support this presentation if you are so inclined. Now, again, some of you might like the shorter videos, and if that's what you prefer, that's okay by me as well. But for those of you that enjoy these longer presentations that get into a bit more analysis with the 12 grids and these trade application examples and all that, then that's the only thing we ask out of you. Just take the 5 seconds out of your day to click like, and we really do appreciate that. So that's what I had for you here tonight. Thanks for stopping by. David should be back with you tomorrow, and then I'll see many of you next week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.